The Voice of Risk, Wall Street CEO's voice pitch, and the 2008 financial crisis. Here I would like to share my new research paper together with Professor Min-Jung Kang of the University of Michigan Flint and my two RAs, Chao Si-jia and Park Soo-hyun. Now, the motivation of this paper is this. Cross-sectional variation in CEO traits has significant explanatory power upon corporate policies such as investment and leverage. Management literature, they started with Hambrick and Mason's operational theory. Financial economics, Bertrand and Schwarr 2003 started as management style literature. And following that, Malmendier and Tate brought overconfidence, psychological bias of the CEO into this literature, and Kamiya, Kim, and Park brought aggression potential that we can capture with their face pictures. Now, the next, we are thinking about voice. But before that, Fee, Hadlock, and Pierce had a very important paper pointing out that the impact of CEO style upon corporate policy is not completely idiosyncratic, but largely determined by the board's optimal decision about the firm's strategic direction. So our paper is not a causal, we are not claiming causality here. We are just studying the association, but very important and alternative data coming from your voice. And it would be interesting, we thought, if we could find common changes in corporate strategy across different companies that are met with coherent changes of CEOs in terms of the traits that could proxy the strategic direction of the firm. Now, the global financial crisis in 2008, in this sense, provides a very interesting testing ground. Financial institutions are heavily regulated in the first place, but before a global financial crisis, the regulators were rather, let the market go on and then gave some more flexibility to the bankers. So Wall Street firms fiercely competed for highly risky businesses for higher returns, such as subprime mortgages, ninja loan, right? And then CDOs and CDO squared, if you watch the movie, The Big Short, right? But you know what happened in 2008, 9, and 10. Once the Bear Stearns and then the Lehman Brothers and AIG went down, the government had to bail out. With whose money? Your money, okay, taxpayers, right? Then the taxpayers got really, really pissed off. Oh, the bankers excessively taking risk, and then once it is going down, we have to pay the tax. We have to, pay for that. Whereas the bankers are partying with so much money. Where is their sense of ethics and, all the moral hazard problem? They were arguing about it. And moreover, adding salt to the injury, there came Goldman Sachs email insight, right? Once they sold CDOs, very complicated derivatives product, instrument to their clients, as much as $600 million. They shared their email internally saying that, boy, that Timberwolf was one shitty deal. That email was disclosed in the U.S. Senate hearing by Michigan Senate Carl Levin, none other than in Michigan Senate, right? Now, that triggered really a public outrage, and moreover, in 2010, I believe, Goldman Sachs CEO had an interview with the British media, the Times, in the Sunday Times, I think, and then it was titled very provocatively saying, Goldman Sachs CEO saying, we are doing God's work. That's why we got paid so much. Of course, his intention was not that malicious. He was claiming something like Adam Smith, invisible hand, the capital markets functioning, and then the banker's role in that capital market. Very important economically and then theoretically. But the journalist was citing in that malicious way. That added one more time the fuel to the burning fire. So the Occupy Wall Street movement really popped up, and then the government had to do something about it. How? Well, the government solemnly directed the banks to reduce their risk level, reflecting taxpayers' outcry. And then Dodd-Frank Act and Volcker Rule were typical, the most notable things that the government was doing it, taking action, legal action, right? Volcker Rule was saying that, don't do prop trading, don't do risky business with your equity, own equity in Wall Street banks, right? Try to be safer, financial stability. So consequently, the boards of Wall Street firms had to drastically change their risk-taking strategy after the GFC to comply with the regulator's intention to reduce risk, to the extent that a trait of the CEO fits the strategic direction of the board. The latter could replace the CEOs to better match the newly enforced regulatory environment. Then the question becomes, what behavioral trait of the CEO could be a valid proxy for the risk strategy of Wall Street firms? Okay, there comes neuroendocrinology. Testosterone, a steroid hormone that causes sexual dimorphism in adult males, has a positive effect on risk-taking, competitive behavior, aggression, and achievement drive. And high testosterone is associated with lower voice pitch among men because the male hormone influences the vocal folds to grow longer and thicker during puberty. So many researchers in this area verify this. And then just a sidekick is that the vocal fold over here, okay? In Korean words, this is called Seongdae. Coincidentally, the school that I'm working for, right? Seongkyungwan University is called Seongdae too. The same pronunciation, Seongdae. That gives me one more reason to study this, right? So the vocal fold is like a drum, okay? Whether you beat the big drum or smaller drum, you hear the difference. You can imagine that, right? And that growth of your vocal drum, okay, has to do with the testosterone during your teenage days. And if you're guys, you must remember the day your voice was abruptly changing or gradually. And the female, if you are, then you remember your, male friends, their voice changed in their teenage days. That has to do with their testosterone, and that goes together with their aggression potential. And naturally, that goes together with the risk-taking in this corporate setting. Sapolsky in 2017 brings a great discussion in this. He is a great scholar in Stanford, neurology and then psychology and medical school. And he has a great book titled The Behavior. And he points out this. Testosterone is understood as the hormone that drives a person to behave more aggressively in search of social dominance. Alpha male, right? Alpha male gorilla drumming, right? You remember that King Kong kind of things, right? That's testosterone. The manifestation of aggressive predisposition of a person heavily depends on the social context. What does he mean? Well, let's say your testosterone is exploding, but somehow your social achievement is limited somehow. Then you get stressed up so much. Then what do? You express yourself, and then become more violent. But does that mean that you're going to beat the super male, like a high-ranked monkey or high-ranked gorilla? No, actually that rarely happens. Instead, what happens is that you beat inferior guy, smaller guy, and then, demonstrating your own testosterone, right? In that way, and then you get rather happier. But that kind of violent behavior, okay, is not allowed in human world. Rather, in corporate world, your expression of aggressiveness is allowed somehow in terms of risky decision making. So CEOs' expression of aggression potential, okay, it will show up in their risky decision making. So our first hypothesis goes like this. Mayu, Parsons, and Venkatachalam, 2013, find out that deep-voiced CEOs manage larger firms and receive more pay because high testosterone, proxied by CEOs' voice pitch, drives them to pursue social dominance. Male CEO's voice pitch could serve as a proxy for corporate risk strategy, given that it is a biological trait that is directly linked to his testosterone level. So our first hypothesis is deep-voiced CEOs in Wall Street managed riskier firms before the 2008 financial crisis. Second hypothesis goes like this. CEO incentives is jointly determined by the risk preference of the CEO and the strategic direction of the board, because it is a mechanism to align the interest of the CEO with that of the shareholders. That's quite standard in Holmstrom and Milgrom and Schleifer and Vishny incentive literature. And Graham, Harvey, and Puri find out that CEO pay reflects the risk aversion of the CEO. At the same time, board of directors with aggressive risk strategy would allow more high-powered compensation structure to its CEO. So we say deep-voiced CEOs in Wall Street had higher powered compensation before the financial crisis. Our third hypothesis goes like this. After GFC, regulatory actions were taken to reflect the public outrage against the irresponsible and excessive risk-taking of Wall Street banks. The board of directors of Wall Street firms may have tried to find CEOs that better match the newly intended strategic direction of emphasizing financial stability. CEOs with aggressive risk appetite may have been more likely to be dismissed due to the effort of the board to find better matches. So deep-voiced Wall Street CEOs were more likely to be dismissed after the 2008 financial crisis. Now, is there any anecdotal evidence? There comes Barclays. Number one, my friend in Singapore, Barclays, we shared a drink together, and then he was complaining at one time. And he was like, Andy, you know what? Good days are gone. I work in credit derivatives, but previously, before crisis, we could have a lot of fun, buying and selling the derivatives. But after the financial crisis, Dodd-Frank Act, right? We can't do anything. Our hands are tied. Okay, so Barclays CEO coincidentally changed from Bob Diamond into Tony Jenkins. Bob Diamond came from investment banking background, M&A, very aggressive nature in that industry. You remember that. Tony Jenkins, retail banking, very safer job. Now, their voice pitches is this much different. Bob Diamond, if you listen to this, you can see that, in a sense, it is about pay for performance, right? We get paid much, that's good. But Tony Jenkins was saying in higher pitch, 130, as opposed to 111 over there. In essence, we mean this is a better Barclays, safer Barclays. So those two very interesting contrasts happened. Data and methodology. It's digitally analyzed voice pitch of 167 CNBC interviews of male Wall Street CEOs during the 2008 financial crisis period, this yellow area, 2008 to 2009 in the middle. And it covers major events like Bear Stearns, AIG, and then Lehman Brothers, and finally lifting of short sale bans. Now, digitally analyzed, right, CEO compensation data. Okay, and then others are quite standard, but voice pitch measure, how do we do it? We use Pratt software, which is quite standard in this voice pitch related research. And then voice pitch data is captured in terms of fundamental frequency F0. Measuring F0 provides a quantifiable indication on voice pitch. And only male CEOs' voice pitch is analyzed due to the small number of female CEOs, and the research has been pretty much established within male group. Okay, but captured from CNBC interview files during the period of 2008 and 9, and then just a screen capture of how it works in Pratt software. You see these voice pitches, and then first 20 seconds of CEO's conversation is analyzed, uninterrupted 20 seconds, by the way. And then, because of the omitted variable bias, we capture and then transcribed every single word the CEOs and the journalists were talking in those interviews using Excel spreadsheet and typing by hands. It's 10 years ago. My diligent RAs in Singapore were working really hard, and they're perfect English speakers, by the way, and then high scored, by the way. So there is quite reliable quality, high quality. And then each segment, we have the timestamp of what second they started this conversation and what second the next person started. And then each and every word, and then topics, we were capturing it. By the way, so in this way, so we were able to capture their language-based psychological biases. For example, narcissism and self-attribution bias. Those are controlled. Of course, the facial width to height ratio, we also have it. We control for that. Also, we have option data, so we control for CEO's overconfidence. Now, firm characteristics and CEO characteristics like gender and age, not gender, but because it's all male, but the age, tenure, these are controlled. Anyway, now CNBC interviews are not randomly assigned, so there must be some selection bias. You are right. So we use Heckman selection model. The idea here is that what's the exogenous shock that could increase the likelihood of having an interview, but not affect the risk preference of the CEOs. So we use two instrumental variables. One is terrorist attacks nearby the headquarters of the company. Why? Because those exogenous terrorist attacks will increase the likelihood of media attention, coverage of the company. So they will have more chance of having interviews. But it does not necessarily have to have CEO's risk preference. And then number two is your neighborhood companies having CEO interviews on CNBC, because network externality, nearby firms would be also more likely to be receiving media coverage subsequently. So those two are used as our instrumental variable, and then we use Heckman selection model to come up with this IMR, inverse Mills ratio. Now the next the result shows up like this: very significant terrorist attacks, and then same state companies interviews, and then you are more likely to have interviews, right? And then we not only work with the pure voice pitch, but also work with the residual voice pitch. What do you mean? Well, the voice pitch of yourself will be affected by some mechanical, the situational variables on that day, or for example, it could be that if your company's stock performance is good or bad, then your voice pitch may be affected, okay, because of the confidence level. And also, if you are the CEO and then you have to say more negative words, then it may affect your confidence level, like testosterone, because bad information you're disclosing, then you get more shrinking, so that your voice pitch may be going up. Okay, vice versa. If it is more positive, then you'll be more confident and then demonstrate yourself, and then the lower voice pitch. So that kind of mechanical effects we want to clear up. So we obtain residual voice pitch. And then your age also matters, because younger guys have higher testosterone and peaking at the age of 31, and then it goes down exponentially. So quadratically, convex ways. So we control for the age and age squared. And so that's how we, get the residual voice pitch, and then run regressions in the subsequent analyses. And then we find that the residual voice pitch is negatively associated with the total risk of the firm, controlling for other firms and CEO characteristics and pay characteristics like this. And then residual voice pitch is negatively associated with percentage of equity compensation, which means your stock options and then stock ownership relative to your total compensation. So risky pay you like if you are a risk taker. That's confirmed. And most importantly, more risk takers were fired, more likely to be fired after the financial crisis. Lower residual voice pitch CEOs were more likely to be fired after the financial crisis. Controlling for your facial masculinity and self-attribution bias. For example, this one is about blaming others. Don't blame others, man. You're gonna be kicked out, right? Narcissism. It's all about me, like Donald Trump. You'll be fired, man. And then other factors controlled, right? So that's our final result. Additionally, we also test what happened afterwards. New CEOs, were they higher pitched? We find some marginally significant results. For example, either they were replaced by higher pitched male CEOs like Barclays, or by female CEOs. Financial stability by the regulators, we could see that. So that's our finding. Now, I hope you like it. And then this paper is published by, accepted by Asia Pacific Journal of Financial Studies in special issue of FinTech. Professor Hyun-Soo Choi of KAIST, thank you. And then the referee, I really appreciate your comments and suggestions. We also appreciate all the detailed comments, and then by Sumi Tagarwal, Renee Adams, and then Simba Chang, and Francisco Dacunto, Martin Dierker, and then Joey Engelberg, Clifton Green, Daniel Hauser, Chuan Yang Huang, and then Nuli Kim, and then Ku Gangmo 교수님, and then Inmu Lee and Kwan-Hui Lee, Soyun Lee and Woo-Jong Lee and Jennifer Lerner, Emma Lee and Ed Len, Chris Parsons, Harminder Singh and Meyer Stadtman, Alexander Wagner, Ya Chang Tseng for insightful comments and suggestions, right? Thank you very much. And then hope you like it and subscribe it. Thank you. Bye-bye.